Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and today we're going to be going over why I am selling Foot Locker stock and I'm replacing it with Coca-Cola and Pepsi. As you can see here, I deposited another $25 into my account. I'm now depositing $25 a week, and you can see my 11 buy orders here. We'll be buying more of Coca-Cola and Pepsi, and then some of my other stocks that I already owned as well. And I'm completely selling out of Foot Locker, the entire 2% of my portfolio. So far, the portfolio has been doing very well. Those of you that want an update on the entire portfolio, make sure to stay towards the end of the video. But you can see the two underweight holdings right here, Coca-Cola and Pepsi. I did decide to increase their position. I'll be going over why. I'll be going over why Foot Locker cut their dividend, the growth strategies, and some of the products behind Coca-Cola and Pepsi. And then we'll be updating you guys on my dividend income next time in the video. But those of you that are interested, make sure to stay until the end of the video that would like to see an update on my entire portfolio. And speaking of updates, I would like to update you guys that I now have double digits. I now have 10 referrals so far for those that have used my link for M1 Finance. Thank you guys so much that have used my referral link, U10. It helps so much in times like these when money is a struggle and times are tough. So thank you guys so much. Those of you that are watching the video that are interested, make sure to use this link down below. It's in the description of all of my videos. So if you're interested in using M1 Finance and getting started, you can earn a free $10 just by getting started right there. But first off, let's get into Foot Locker. So Foot Locker decided, along with Ross Stores and Halliburton last week, to cut their dividend. So Foot Locker is now at zero. Ross and Halliburton are all at zero. It's funny, I actually wanted to use this article because I recently mentioned that I thought Ross was not going to cut their dividend. So it's a bit of surprise to me because after I filmed that video, literally like 3 hours after that, Ross announced that they were cutting their dividend. So that was a bit of a surprise there. Halliburton, that's no surprise. The oil companies are really having a struggle right now. But Foot Locker decided to cut their dividend to zero. So I don't think M1 Finance has updated it yet. So let's go ahead and search FL stock, which by the way is having a very large day in the green. So I'll get to sell it a little bit higher, about $2 a share higher than I would have yesterday. But right now the yield sits at about 5.74%. So it had about a 6% yield before the cut. I believe actually when it was at its bottom during the March lows, I believe at one point it might have gotten close to about 8%. I know my cost basis on this stock was about $20 a share, so we're selling it for a pretty significant gain. I am selling it because those of you that know that watch my videos, I am a dividend investor. I do not care so much about share price gains. I believe it was like $19.84 was my cost basis on Foot Locker. So we're selling it for a much higher return. So it's about a 40-ish, 40+% return in just a matter of about 2 months. So that is very, very awesome. If I am going to sell a stock, it is nice to get to sell it in the profit. Those of you that watch my videos know that I did just sell one of my losers in my portfolio because I do think in the next couple of weeks, next month or two, I think that Wells Fargo will end up cutting their dividend, especially with an 8.19% yield. I assume that they're going to be one of the next ones to cut their dividend, but who knows? I might be wrong, but they had a poor management team, and Foot Locker is not as focused on that dividend as I thought they were. I thought the management team had excellent growth behind it and was focused, but right now they're more focused on retaining cash and having survivability in a time like this, which is completely fine. I understand that. But as a dividend investor, I'm going to have to cut it. The one thing that I talked about in one of my previous videos was the sunk cost fallacy. The definition of sunk cost fallacy is in economics and business decision making, a sunk cost is a cost that has already been incurred and cannot be recovered. Sunk costs are contrasted with prospective costs, which are future costs that may be avoided if action is taken. Basically, what that means is that if you have a winner or a loser in your portfolio, you are let emotions determine your decision making. Now, if you have a winner, for example, that is up 30, 40, 50%, Foot Locker, I believe, was the second best performing stock in my portfolio. I was up 40+% on it. But that doesn't mean that's going to hide me from selling it. It may go up. I believe now that they cut their dividend, their share price will probably go up in the long run. I'm sure we'll probably see this go back to the 30s, 40s, maybe even the 50s one day. But that doesn't mean I'm going to keep it because they're not paying me out that juicy dividend that I'm focused on. Now, the sunk cost fallacy is on the flip side. Wells Fargo was one of the worst performing stocks in my portfolio, but I sold it as well. Now, just because I was down on that position, that would be known as the sunk cost fallacy if I held it and held it and held it and continued to lose money and get worse returns, knowing that I would get better returns putting it in someone else just because I didn't want to face the fact that I made a wrong decision. I am not perfect. I own over 30 companies, and every now and then I will make mistakes. Wells Fargo was probably a mistake. It was a mistake investing in it, but that's okay. Now we're going to put our money in better run, more well financial positioned companies. Now, the two companies I'm going to be increasing my position in, it's about 1.1% down. I increased my target from 4 up to 5% for Pepsi, and Coca-Cola I increased to 4% from 3%. It's about 2.9 right now. These buy orders are about to execute any minute now. But with both of these positions, there's a few reasons why I picked Coca-Cola and Pepsi. Now, first of all, I think their business model is very safe, very stable, and I think they're going to keep their dividend regardless of how long this recession lasts. But one thing I wanted to point out, I wanted to point out two different stocks here. So first of all, let's search HD, Home Depot, a very safe, stable dividend company. They are thriving in this business environment. But let's look at their stock price. They are basically at all-time highs. Actually, just 3 or 4 days ago, they were at their all-time high. This is a $245 stock, and they went from $150 to $245. They increased $100 in share price, and their dividend yield is only about 2.3% now due to the recent rise in share price. And the same thing goes for, I'm going to give another example, Johnson & Johnson, another very old, safe, stable dividend company. But let's look at their share price. It's just a couple percent off from its all-time highs. And not to mention the dividend yield is only 2.6%, nothing that's astronomically high, it's okay. Now let's compare it to Pepsi and Coca-Cola. If I type in PEP, and that's a ticker symbol for Pepsi, let's look at the 5-year chart on that. It is still quite a bit off from the highs, and even at these prices, 2.93% yield is pretty fantastic. The funny thing is that actually that hasn't calculated in the new dividend raise. They just raised their dividend about 7%, so actually this is over 3%. That hasn't been updated yet. So I'm buying Pepsi at this valuation at over a 3% dividend yield for a company that is very safe and very stable. Comparing that to Coca-Cola, this is another thing I wanted to point out. Look at the share price difference for Coca-Cola. Coca-Cola is more than likely never going to cut their dividend. They're a very safe company, just like Pepsi, and you're buying the share price today at a 3.6% dividend yield? That is so high. This was a stock that had a share price that was over $60, and now you're buying it at 46. So you're buying it at a significant discount, 20 plus difference from what you would have just 2 or 3 months ago. So this stock is a very safe, stable stock, and that's why I don't want to put my money in a very safe, stable stock that's like Johnson & Johnson. I don't want to be increasing my position to all-time highs. If Johnson & Johnson was $130 a share, it would have a higher dividend yield, and I would be buying it at a better share price where I can increase the amount of shares that I own per purchase. That's not a stock I'm going to be putting my money into. Other stocks that I own are sky high, are at all-time highs. So like look at Apple, for example. Apple has barely even skipped a beat. Another one that I own, Microsoft has barely skipped a beat as well, all-time highs, and the dividend yields are extremely low. Do you see the pattern that I'm trying to point out here? So when I point out Pepsi and Coca-Cola, I think on both share price gains and on dividend yields, this is probably the best location I can put into my portfolio right now without increasing any more positions in my portfolio. I don't really feel like adding any more positions right now with the market recently going up, so I'd rather just increase my positions for the positions that I already have. Another thing that I wanted to point out, just one last thing, and then I'll start diving into why I chose Pepsi and Coca-Cola. Home Depot, for example, like the one I gave, I am up so much on the stock. I'm up 37.05%. So if I want to buy extra shares of Home Depot, I'm buying 37% higher than I would have compared to a Coca-Cola where I'm up 4% and a Pepsi where I'm up a little under 4%. So I'm nearly buying it at the same price I originally would have. So I'm not really raising my cost basis significantly higher than I would have just a couple months ago. But anyways, I wanted to point out the two survivability and the growth strategies behind Pepsi and Coca-Cola. We'll also be going over some of the products and why I think they're sustainable for the long term. So first of all, we're going to look at Coca-Cola. I went over Pepsi quite a few times on this channel, but I've never really dove very deep into Coca-Cola. Coca-Cola, they have had some recent acquisitions, just like Pepsi, and this is one that I wanted to point out. Costa Coffee. So one company that I recently added to my portfolio was Starbucks. Coffee in America is absolutely exploding. It is a very high growth area. There's so many other competitors into the space. They're trying to get a piece of the growth pie, and that is coffee in America. So this is a perfect strategy for Coca-Cola to try to get deeper into that space, and I think they will be very successful from this. In January of 2019, so about a year ago, they completed the acquisition of Costa Limited from White Bread PLC. The Costa platform will give us the ability to scale within the $500 billion global hot beverage category and create a world-class global coffee business, allowing us to better serve our customers and strengthen our ready-to-drink portfolio. And then it shows what their strategy centers around. You can read these bullet points right here. So this is a strategy to where they're constantly developing into new categories and more high growth segments. So when you're a company like Pepsi or Coca-Cola, you can only grow that one brand so much. So when you're Coca-Cola, for example, nearly the entire world drinks Coca-Cola already. So it's really hard to grow from that other than the fact of population growth. So how do you sell more Coca-Cola when everyone already drinks Coca-Cola? You can't. You can't really. The only way that you can really grow the company, grow the business, put them in a better financial state is to constantly buy out smaller high growth brands. So another perfect example of this is Pepsi. I will be going over this in just a second, but Pepsi recently bought out a energy drink. They just recently brought out Rockstar. Pepsi has a lot more brands than Coca-Cola, which is one of the reasons why I put Pepsi at a higher target percentage than that of Coca-Cola. But Pepsi just recently brought out Rockstar, and the energy drink and the sparkling water section is a very high growth category right now. So many other drink brands are rushing to this space, and I think that is going to create a lot of revenue growth for Pepsi. And speaking of sparkling water and energy drinks, one thing that is not mentioned on this section right here is that Coca-Cola just recently announced their brand AHA, their sparkling water brand. They're now going to create more revenue from their new brand from sparkling water, and that is going to be another high growth area for Coca-Cola on both their Costa Limited M&A brand and as well as their sparkling water brand Aha's. That is a very high growth area, and they continue to get growing revenues from that. So one thing that I also wanted to point out at Coca-Cola before I get to Pepsi here, we were talking about sustainability and revenue growth. So when you can't really grow a Coca-Cola, for example, that has everybody drinking it, you got to put little twists and tweaks on the brand. So it shows an example here from North America, from the US, and one that is overseas from Romania, for example. So let's look at the traditional 12-ounce can versus the mini can, 7.5 ounce. This has only 90 calories and 38% less sugar. So one thing I wanted to point out here is that I've talked about the only real risk that I could see with Coca-Cola and Pepsi, because they are such dominant beverage makers, is that the only thing that could really risk their business model seriously is if the governments were to step in and basically eliminate sugary Coke, sugary drinks. And that would be the huge threat to Coca-Cola and Pepsi that is experienced every day. And so they're looking at ways to not only grow the company, but also eliminate that threat. So as you can see here, since it only has 90 calories, 38% less sugar, it also has better growth than that of the traditional soda brand. It has double-digit volume growth ahead of the 12-ounce packs. So the craziest thing, not only is this healthy for the consumer because it is about half the size of that or the traditional Coke can, but it has double-digit volume growth ahead of the 12-ounce packs. So it is literally growing double digits faster than that of its big brother, the traditional can. Not to mention it has roughly 2 times system growth profit. So not only is it growing faster, selling more, it has more profit, and it's healthier for the consumer. People are drinking these smaller cans and they don't realize it. They get accustomed to drinking only 7.5 ounces versus 12 ounces. So that's healthier for their system. That's less sugary drinks in their system. But Coca-Cola is making more profit and more volume growth off of this. So this is a very intelligent business decision by Coca-Cola, while they're doing other similar examples in example Romania. So this is a convenient on the go versus a 2-liter bottle where they have sleek can single serve packs and glass bottle single serve packs. It has lasting refreshment, premium look and feel, and tailoring to more consumers. And I think that this is a system that is working very well in both North America and Romania. So it has 19% system revenue growth compared to the 11% of traditional multi-serve. So as you can see here, 19 versus 11, that is an 8% revenue growth difference on these bottles of Coke versus this bottle of Coke. An 8% difference. When you're talking about a scale that is as large as Coca-Cola, an 8% difference, a double-digit growth difference, that is massive. We're not talking about thousands of dollars. We're not talking about millions of dollars. We're talking about billions of dollars. That is a huge difference, and let's go ahead and compare that to a company like Pepsi. So one of these subjects that I wanted to point out here, it was talking about improved choices across our portfolio. It talks about reduced added sugars. About 67% of beverage portfolio will have less than 100 calories from added sugars per 12 ounces by 2025. It has reduced sodium. About 75% of foods from the portfolio will not exceed 1.3 milligrams of sodium per calorie by 2025, and then reduce saturated fat. As you can see, the CEO recently came out and had a lot of growth and metric targets for 2025, improving the products, improving the packaging. As you can see here, there's one category here. It's talking about eliminating plastic by 2025 completely. And this is a company that is focused on the long term. They're not talking about reaping every bit of reward and pinching every penny to get every amount of profits, because they know consumer habits change constantly. It is constantly changing, and people are having more and more demands for different areas. So, for example, 20 years ago, people weren't worried about plastic. Having plastic issues for packaging was non existent. People weren't worried about that. But now it is a huge focus for not only investors but consumers as well. So they were looking to eliminate plastic packaging by 2025, and I hope that they end up doing that. And then I've mentioned this before, but one thing I wanted to point out here about PepsiCo is that their brands are so wide and so diverse. So if you can see here, we're going to click beverages, and then we're going to go over their beverages and food brands. So Coca-Cola does have a reasonable amount of brands, but Pepsi has so many. So we have Pepsi, Pure Leaf Tea, Mountain Dew, Bubbly, Gatorade, Tropicana, Naked, SodaStream, Lipton, Starbucks Frappuccino Packaging, Aquafina, Brisk, Kavita, Lifewater, Sierra Mist, Stubborn, Izzy, Propel, One, Sophie, Mug. And then if we go to their food brands here, they have Lay's, Doritos, Stacy's, Quaker Oats, Bear, Sabra, Ruffles, Smart 50, Cheetos, Tostitos, Fritos, Near East, Maker, Imagine, Sunchip, Smart Food, Off the Eaten Path, Simply, Rolled Gold, Miss Vicky's, Red Rock Deli, Cracker Jack, Nut Harvest, Life, Matador Jerky, Chewy, Santitas, Funyuns, Cap'n Crunch, Pastaroni, Rice Roni, Quaker Oats, Maui Style, Sabritones, Munchies, Munchos, Grandma's Cookies, and Aunt Jemima. You see so many different brands from Pepsi that are so dominant that you see and probably eat and drink every single day. The one reason why I like Pepsi better than Coca-Cola is for two reasons. Financially speaking, they're both very close, but I think Pepsi is in a slightly better position on both the payout ratio and the dividend growth, so I like that. And so many of Pepsi's brands, specifically the food brands like your Doritos, your Lay's, your Ruffles, your Cheetos, so many brands I think are more dominant than that of Coca-Cola's because they have food brands. Coca-Cola does not have any salty chips, any salty snacks, any candy bars, no beef jerky, anything like that. They only have beverages. Coca-Cola has beverages while Pepsi has beverages and food products. So I think that will give them a more dominant position in the long run as we get further into the future. Now, in the same way that beverages have high growth areas like the sparkling water in the energy drink section, the same thing goes for food sections as consumer habits change. And I think this will also put them in a better position, talking about Pepsi, to better take advantage of the consumer trends that happen in the food areas in the coming years. So that is the reason why I'm adding Coca-Cola and Pepsi to my portfolio at a higher percentage than it was previously. And this is what I think is going to make a very successful move for me in the future over the coming years. And I'm not going to sell either of these stocks anytime soon, as I won't be selling majority of the stocks in my portfolio as long as they keep that dividend. So those of you guys that have made it all the way to the end, thank you guys so much for watching. A quick update on my portfolio. Today is a very, very green day, up 2.42% or about 53 bucks. And in total, we are now up 15.84, almost 16% in the portfolio, about $267 in gains. I believe that's actually wrong. I'm not really sure why they calculate it on money-weighted returns. I've deposited $1,900 into the portfolio, so I'm actually up $346. Money-weighted returns don't really make a lot of sense to me, and I don't really care for them. But it has $254 coming from market gain and $13 coming from earned dividends. And you can see my percentages that I'm up here in the portfolio. In the portfolio, the biggest winners are still some of the same names like Whirlpool, Discover, Home Depot. Like I said, we did just sell out of Foot Locker, and we are now up 54% on Whirlpool after today's gains, and we're just a penny or two off from being up 50+% on Discover Financial Services, so doing very well, and we're only down on two stocks, Verizon and Procter & Gamble. We'll be lowering down on those positions and getting better gains, and we're even up on our new position, Starbucks, and we'll be increasing our position in these two like I just mentioned. So thank you guys so much for watching. Those of you that made it to the end, if you haven't done it yet, be one of the 10 lucky people that use my successful referral link so you can get $10 to get started on M1 Finance. It's so much better than any other brokerage compared to a Robinhood or one where you have to pay commissions. Everything is absolutely free. I can help you get started investing in this portfolio. And if you're interested in using the portfolio that I use. I do share this pie in all of my videos, so you can use this link. So if you're interested in using there, make sure to leave a comment down below what you thought about Pepsi and Coca-Cola as an investment, and am I making the right move on selling Foot Locker? Thank you guys so much for watching, and I'll catch you next time.